Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me a former budget director under Ronald Reagan and former Michigan Congressman David Stockman, and also Ms. Shedlock, Michael Shedlock, more commonly known on the Internet as Ms. Shedlock. Both men have been on this show before, and both are very well known, so I'm not going to take the time to read their bios, which are, though, posted at the Voice America, on my website at the Voice America website, business channel. However, I would be remiss if I did not strongly suggest to all my listeners that you begin following the work of both of these gentlemen if you don't already do so. David Stockman, Ms. Shedlock. David's website is it's David Stockman's ContraCorner.com. And Ms. Shedlock's website is globaleconomicanalysis.blogspot.com. And both men contribute their very valuable insights. They write their pieces there, but they also have a lot of guest writers. I find both of those websites very, very interesting and important. So welcome, David, and welcome, Mish, to Turning Hard Times into Good Times.
Very happy to be with you. Hey,
Thank you.
Jay, a pleasure to be back on, and it's certainly a pleasure to be on with Dave Stockman, whose work I've admired for some time.
Well, and I think he has picked up a lot of your work too, Mish, which is why I thought about having you on together with David. Certainly, one of the things I would say about Mish is that he is one of the most passionate people I've ever met. I've been on panel discussions with Mish before, and I think I sort of felt like maybe Mish was the only one on the panel because he feels so strongly about things. Sometimes, as we were getting ready to come on the show, I had to shout to Mish, "Be quiet, hold your firepower. We're going to ask you in a minute to come on and talk about this stuff," because when he gets going, you can't stop him. So it's good to have Mish. It's good to have both of you with me again. You know, David, this show, Turning Hard Times into Good Times, was launched back in March of 2009, almost at the bottom of the financial market crisis. The timing couldn't have been better because we're free market orientated, and a lot of people were starting to say, yeah, maybe the Fed and maybe the powers on high don't have all the answers. And so there was a reception to this show. Immediately this show became the top show on the Voice America Business Channel. The numbers grew dramatically out of the gate. Since that time, though, the stock market has continuously made new highs. Things seem to be pretty good again. And our numbers have declined to the point where they're less than half of where they were at the peak. So it seems as though Wall Street, at least, or a lot of people that were listening to this show, sort of now once again have faith in the PhD standard, as James Grant calls it. Can you share with our listeners why you think an implosion in our markets is near and why we are going to see the end of bubble economics sometime soon?
Well, you know, I think this is totally artificial. The policy of the Fed and the other central banks of the world defy any traditional views of sound money and prudent management of the financial system. At the time you started your show, as you've indicated, the balance sheet of the Fed was about $900 billion. It's $4.5 trillion today. Therefore, you know, it's up 5x in a very short period of time. Liquidity is just poured into the financial markets. They've really been ruined and destroyed. There's no real honest price discovery left. The bond market has been massively levitated and overvalued by the huge QE bond buying of the Fed and other central banks. The put that started with Greenspan and continued through Bernanke and Yellen today is totally undermined the honesty and the reliability and the stability of the stock market. In a post that I did recently, I just put a picture of the S&P 500 from the very day that you began your show, coincidentally, to the present. And if you look at that chart, you can see this isn't natural. This is a market that's habituated to buying on the dips because they're absolutely confident that the Fed will not allow the market to drop by more than 5 or 7 or 9%. And as you move up the curve over the last 5 years to the stratospheric levels that we're at today, you can see that the dips are getting shallower and shallower. The market is getting more and more bold in terms of its utter, willingness to ignore the risks that are building. And so I think here we are at the edge of the third and greatest bubble of this century. After .com, we learned nothing. After the housing credit bubble and massive catastrophe that resulted, The Fed learned nothing, and now they have us extended out on the very edge of another dangerous bubble again. And so here we are 5 years later waiting for the next shoe to fall.
But they've generated what Keynes like to call animal spirits. And so, people were licking their wounds back in 2009, and they've, the experience has been, the most recent experience has been, go long the stock market. You've got nothing to lose. What will trigger, what will cause this thing to crash? What will cause it to come down? I would like to get, I guess it's hard to say what will cause it, but do you have any sense of what some of the tipping points might be, or the catalysts might be that cause this thing to go in reverse, David? And then I'd like to get Mish's opinion on that as well.
Well, it's hard to predict, but there will be a catalyst or a black swan. No one saw Lehman coming. The urban legend now is that the whole disaster we had was due to Lehman, and if they'd only bailed it out, everything would have been okay. That's nonsense. Right. The economy was tipping on the edge, and that was the catalyst. So who knows what it will be this time, whether it's the crisis in the Ukraine or something that comes out of the blue. I can't tell you, but when you have the market trading at nearly 20 times honest trailing earnings, when you have the more speculative stocks like the Russell 2000 at 80 or 85 times, when you have the market going up in the face of an economy that's struggling at best or maybe sinking into another decline, when you have the headwinds all over the world that we see today, the house of cards in China, the old age colony in Japan, the welfare state crisis that is holding down the European economies, why would you think that the market ought to be valued at the very top of historic ranges when actually the capitalization rate, given all the problems in the world, ought to be lower than the historic norm, not higher? So I say, we're at the edge of a disaster waiting to happen. It will not take much to kick it over, and so therefore it could happen at any time.
Right. Mish, what are your thoughts on this? What might be a catalyst? Do you have any ideas?
Well, let's back up to the first set of questions you asked, David. Let me point out that, and I'm sure David would agree, that it's not just the U.S. doing this. It's China, it's Japan, it's third world economies in general. All the central banks worldwide, in Canada, Great Britain, have stepped on the gas in response to any sort of crisis. In fact, the only thing they've learned how to do, because it appears to be working, when it's not really working, just as the Fed did with the housing bubble in 2000, Greenspan stepped on the gas to bail out the banks, who were then under serious stress from bad loans to South America, and also from the dot-com bust. We stepped on the gas, created a housing bubble, and the Greenspan mentality is, we'll deal with the aftermath. Well, here, the aftermath has just been bigger bubble after bigger bubble, and arguably we're back in a bigger bubble now than the housing bubble that preceded it, and the only reason why we don't see it now is because it hasn't popped yet. But make no mistake, its global money supply is expanding at a far faster rate in China, and as for what the catalyst is going to be, I suspect it's going to come from Asia, from China or Japan, as opposed to something here in the United States. But bear in mind, there doesn't have to be a catalyst at all. The housing bubble in the United States ended out of the blue. People one night were camping out overnight, waiting in line for the right to buy a Florida condo. They're entering lotteries for the right to buy a Florida condo. 2 weeks later, no catalyst. The lines vanished. No one wanted those condos. So simple exhaustion can do this, but we also might have a trigger, like David said. It might be the crisis in Ukraine. And speaking of which, Germany and France are both going to be impacted severely if more sanctions are loaded up on Russia, as President Obama wants to do. So the United States might precipitate this crisis, the next downturn, by pressuring all of Europe for more sanctions on Russia here.
Yeah, it really is interesting to note the division, the divisiveness of this whole issue, and the incident that took place recently, the aircraft going down. Well, I don't know that we want to open that discussion today because we'll get completely off of economics. We talked to Daniel McAdams of the Ron Paul Institute for Peace and Prosperity. He'll be on this show in the second hour, and we talked to him quite extensively about that subject, and as well as some of the remarks that his former boss, his current boss, Ron Paul, had to say about the questions that our media is not asking concerning the Ukraine. Also, some remarks from Dr. Paul Craig Roberts on that issue as well. So I would love to get into that, Mish. I would love to hear what you have to say about it. I think, though, I'd like to stick with economics, but I do believe that your point is well taken, that could very well be a trigger. We notice already, from what I'm reading, a lot of trade has been deterred from the Ukraine, and agricultural goods that are being shipped out of there and so forth. So this is the war cycles, as Charles Nanner was talking about before you two gentlemen came on, are definitely in a rising pattern right now, unfortunately. And so maybe that's what could really trigger things in a very nasty direction. Well, David, the use of the word implosion in your article, it sort of implies, in my mind at least, that an image of a severe economic contraction, and with that very often comes falling prices. We certainly had that immediately after Lehman Brothers in 2008, 2009. We actually started to see what I would say was deflation across the boards almost, but they were caught the falling knife before it got out of hand and started to reflate again. But do you see, David and Mish as well, after David, perhaps Mish, you could opine on this, do you see the possibility of an implosion, meaning that we're heading into some sort of a deflationary environment?
Yes, I use the word implosion to talk about financial markets, and I believe all risk asset markets are at risk, and that at some point when the markets finally wake up and lose confidence in the Fed, and when their ability to continue to inject confidence and liquidity finally reaches its limits, then we will have a major downrating of valuations across the board, from the S&P 500 to the bond, treasury bond, 10-year bond, and everything that's priced off from that, including the insanely low yields that you have on high-risk junk bonds today. Now, I think that has economic ramifications, which would be the second point. We have had this massive global monetary expansion, as Mish was mentioning before, and I second that heartily. In fact, the numbers are startling. The combined central bank footings or balance sheets of the major central banks in 2006, 2007 were about $5 trillion. They're $15 trillion today. So we have had a massive tripling of the balance sheet of the major central banks of the world. All of that has gone into distorting financial markets, buying heavily government debt, which therefore has been inflated by central bank buying, injecting liquidity into all financial markets, not just Wall Street, which has kept the risk asset boom and bubble expanding. But one consequence of that was a massive malinvestment in production capacity around the world, but especially China. In other words, today China is drowning in excess industrial capacity, from steel to cement to aluminum to solar panels and everything else. That caused the huge demand from China for raw materials caused an enormous overinvestment in mining capacity from bauxite to iron ore, and also a massive overinvestment in distribution and shipping capacity. And so we have the world today stocked up with 10 or 15 years of investment ahead of time in basic production and distribution capacity. And when the financial bubble finally pops, and the continued expansion of debt ends, then we're going to be stuck with this massive overcapacity, which will cause prices to fall. So I think what we've had from this massive central bank experiment is a setup for a major deflation in the industrial and commodity and goods markets of the world for many years to come, as soon as we reach the inflection point in the leading edge of this financial bubble.
Mish, I'm assuming that you are very much in agreement with that view. And but what do you say to the Peter Schiffs of this world that are saying, well, we're printing all this money, we're going to have hyperinflation?
Well, I think David Stockman just explained why we're not going to have it.
Yeah.
Adding to what he said, actually, I have one slight disagreement with him, or perhaps it's just a timing disagreement as opposed to an actual disagreement, and that is in regards to U.S. Treasuries here. Certainly, I think we're going to see a credit event. I think David and I would both agree on that. And if that credit event triggers in Asia first or Europe first, and I actually think it's European government bonds that are overpriced here because of various scenarios. Spain may break away, Greece may break away still. Germany is not out of the woods here yet. I think their economy is slowing rapidly. So I think we're going to see a repricing of government bonds, but that repricing of government bonds is going to start in Europe first, or perhaps Japan first, and the U.S. will be last on the list. No doubt the Fed has distorted things wildly here in the United States, but that does not preclude, if there's a genuine slowing of the economy, as David sees, as I see, a yet one more rush into U.S. government bonds in another, flight to panic. And we're not going to see that same kind of rush because of various breakup scenarios in Europe, and certainly Japan with interest rates on the 10-year under 1%. There's nowhere to go there either, and Japan's in a world of hurt if rates start rising there. So yeah, currency crisis is coming. I think U.S. government bonds for the time being are safe, but has the Fed created a bubble in junk bonds and in assets in general? Yes. And in terms of the overall deflationary setup, once this expansion stops, we are going to see a write-off of all sorts of malinvestments, and junk bonds and covenant-like bonds. Those things are going to get hit. All of these things are part of what anyone should reasonably call a deflation scenario, where we're going to have falling asset prices, probably falling prices on consumer goods, perhaps not that much, but certainly on the value of credit on the books of banks. That's coming again. On the value of credits of junk bonds that institutions are holding, that investors are holding. Boom. That's all part of what I call deflation. Depends on your definition of it. If you stick with the common term definition of massive price reduction, and you ignore, especially if you ignore as everyone does, home prices, well, maybe we just see, as we did in 2008, early 2009, small reductions in prices, but the big reduction is going to be in the mark-to-market value of credit on the books of banks.
So, Mish, that your scenario there, though, expects that the problems would occur first in Asia or Europe, and that would cause a flight to safety in the U.S. dollar and gold too, possibly.
Yes, I'm a strong advocate of gold here. We'll see. Just ignoring all of the conspiracy theories about the Fed doing this or that to gold. I don't buy those. There's certainly manipulations. I believe there's manipulations in both ways. I don't think the Fed is directly manipulating gold. I think others are, but not necessarily all in one direction. But yes, and if you go back and historically look, gold has done very well in two times. In times of credit stress, stagflation, or deflation, gold has actually done well. Gold does poorest in times of normal disinflation, and that's what we've seen now. Falling rates of inflation where everyone thinks, we don't need any protection. We don't need any credit protection. You know, the Fed has our backs. It's this strong belief, which actually is one of the biggest bubbles out there, is the belief that the Fed can do no wrong, that central banks can do no wrong. Look, no. If central banks could have stopped the crisis in 2008, they would have, and they didn't. So why everyone believes that they now can prevent the next crisis is literally beyond me.
That's the question. I think we've all been trained to believe that and trained not to think and to accept what we've been taught in our Economics 101 classes, that we have people, or the PhD standard is superior to the gold standard in free markets. In any event, we do have to take a commercial break. When we come back for a few minutes afterwards, I want to ask David a little bit more about the interest rates and what he thinks would cause interest rates to start spiking up, because I think that is a real key possibility to a catalyst that could really turn the markets on their in the other direction. So don't go away. We'll be right back with both gentlemen as soon as we come back from the break. Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor. I'm really pleased to have back with me for the next 10 minutes or so David Stockman and Ms. Shedlock. David, in your recent article, July 16th, you stated, indeed, in a world where interest rates and profit rate normalization must inevitably come to an end, the capitalization rate for current earnings should be well below normal, not extended into the nosebleed section of historical results. Why do you think that interest rates necessarily have to be normalized, that they have to come to an end? I mean, we're taught that, Bill Gross has talked about a new normal. Certainly Paul Krugman has suggested that there's no reason to panic, that debt's not a problem. We can continue to increase debt. And I like to say that in a fiat currency, debt is the raw material from which money is manufactured. And as I look at all the charts, not just government debt, but total debt, it's almost growing exponentially, and GDP, if it's growing at all, is growing in a very slow, linear fashion. I don't get why Krugman and others think that we can keep going on forever, but yet we've seen a 30-year bond bull market. We've seen interest rates continuing to fall. We've seen creation of trillions of dollars and no interest rate rise. So why do interest rates have to normalize, and might we not be at a new normal, as Bill Gross suggests, David?
Well, I think, first of all, you can't look at interest rates in terms of the traditional model of economics. How strong is the economy? How big is the demand for real credit to invest either in the consumer sector or business productive assets and so forth? You have to realize that for decades now we've been in a financial bubble that's been driven by credit expansion, by debt, that's been enabled by the policies of the central banks. So the reason the stock market is where it is today, the reason junk bonds are trading at the absurdly high values they are today, is that almost all of this has been fueled by leveraged buying. In other words, we've margined almost all of these inflated financial assets with more debt, and then those higher values beget even more borrowing and more margining. And so the reason that interest rates are going to rise is that the value of these overextended fixed income markets, bond markets, both government and corporate, and especially high yield, are going to fall as debt, as the markets go into a panic after the catalyst event, and sell in order to pay back, their overnight loans and the repo on which all of this is owned. I've said over and over, no one really owns the government bond anymore. They all rent it by the hour and by the day on leverage. And so when the panic comes, the break in the market comes, there will be no bid down below. Prices of debt securities will fall drastically, and the implied yields will rise. That is a different economic model. That's a different circumstance than what people might have learned about 45 years ago, prior to the time that we went on to the so-called PhD standard, as you call it, in 1971, and the world went into this sequence of serial bubbles. So that's why when I say that I think the implosion is coming, it's going to happen in the financial asset markets. That will drive yields higher. Higher yields will fuel more selling will fuel a vicious circle, and that's the danger that we face today.
But we certainly faced that in 2008, 2009, and they were able to grab a hold of it and put a stop to it. Are you saying at some point it will be so big that governments can't even do anything about it?
I think that's exactly right. Each bubble has become more fantastic than the prior one. And I'm sure that they're going to invent some new emergency programs with all kinds of alphabet soup of descriptions to try to stabilize or put a bottom in the market when the break comes. And maybe that'll work for a while, but I doubt whether it's going to be as effective as it was after March 9, 2009. Because what Bernanke and the Fed did and the other central banks did at that point was totally novel. This whole idea of QE, this massive, rampant expansion of central bank balance sheets was not even conceivable 10 years earlier. So they stumbled upon that expedient once. It was able to revitalize the animal spirits, but they're really not animal spirits. It's more like trained seals. They're buying what the Fed is telling them it's supporting. But that I don't know that trick can be repeated indefinitely. In fact, if the Fed were to go into another spree of massive balance sheet expansion, in effect reversing the taper big time in the midst of a crisis, I think it could only add to the panic because by then markets will have lost all confidence in the central banks.
We're really talking about a con artistry and a con system in a way to keep people conned and believing in the tooth fairy, in this fiat money system. And Alan Greenspan understood very well when he wrote an article in 1966 called "Gold and Economic Freedom" that gold had to be kept out of the hearts and minds of the people, or else they would demand gold and get rid of the paper money, and the socialist state would not be able to, the war state, the socialist state, whatever you want to call it, that we have now would not be able to survive. So I know, Mish, you opined a while ago that you don't think that the gold markets are rigged, that there's any manipulation of the gold markets.
The gold markets are not rigged in one direction. That's what I said.
Oh, okay.
And they're not rigged by the Fed. I also said that.
Okay.
The gold markets are is there manipulation? Yes, there is. I just want to clarify that.
Oh, okay. Okay, so what you're saying is that they managed to keep a lid on it, perhaps? Over time?
Well, the Fed. I don't believe the Fed is directly manipulating the gold market. I think there's various players who have done that. I mean, there have been fines and other things levied. I just don't believe that a manipulation is all in one direction. I don't believe that there's this massive conspiracy that others believe out there to suppress the price of gold. But along those lines and along the lines of what Dave said, I think when the panic comes, where and I agree with Dave that where is that money going to go to? Where are the price pressures going to be the next time? I think gold is the beneficiary of that. That's just a theory of mine. I can't prove it. But let's sort this through here, and let's assume that Dave and I are right. that there is this panic coming, that we've got an overabundance of these productive assets, that China is going to slow, that the U.S. is going to slow. Let's assume, I think, as a repercussion of that, the jobs are going to be lost. So I just don't buy this notion that prices in general are just going to start soaring. I would agree with David that junk bonds are absolutely going to be crucified. Why? Because we're going to start seeing some more defaults in junk bonds. All this leverage that poured in there is going to come out. They're actually the way to accurately phrase it is there's going to be a repricing of all those risk assets, one of which is gold. I think gold is going to go up. The risk assets are going to go down, and unless prices are going to the moon, I just don't see this catalyst for U.S. Treasuries yields on U.S. Treasuries to go soaring. I just don't.
Yeah, I would add there that I think what's totally different this time is that the inflation has been in the financial asset markets, not the market for labor and goods. And it's been worldwide as a result of the common action of all the central banks of the world. And that has led to a massive financialization of the world economy, a drastic underpricing of capital, and therefore an enormous flow into everything, from bulk carriers to cement plants and empty cities in China. That's different than all the historical analogies. The big inflations or hyperinflations we've had historically have been basically in one country, Germany in the early 1920s. But what happened was people lost confidence in that economy and that central bank, and they had huge external debt in dollars and sterling and so forth. And that was kind of a hyperinflation in one country, and the same is true with modern times Argentina and any of the other examples you want to bring up.
All right. Unfortunately, David, my engineer is telling me we're out of time. So much more to talk about. I'm sorry. I hope to have both of you back sometime in the near future if that's possible. So thank you both, Ms. Shedlock and David Stockman, for being with us today.